Greetings. Just want to follow up with some of the good things we've been learning from chapters 10 and 11. In chapter 10, we spent a good deal of time talking about depreciation and the calculations involved in it. And the point of this short video is something that you'll need to know in the practice of taxation, because it will come up in conversation from time to time, fairly rarely, but still an important point that anybody in the tax departments or doing anything even remotely related to tax will expect you to know, and that is depreciation is a deduction. Like all deductions, as we've learned in the principle of the tax code, all deductions from income are allowed by the fact that there is a statute saying it can be deducted. You must have a rule that says it's allowed. And in the case of depreciation, the statute uses the word allowed. There shall be allowed, sort of like a biblical statement. And if you read the actual law, sort of, like I said, like biblical, it says, there shall be allowed deduction, depreciation against the cost basis of depreciable property, etc., etc. However, it doesn't just stop with the word allowed. It actually goes and uses and adds parenthetically the word allowable. Somehow the writers of the law put the word in parentheses, depreciation allowed or allowable. This has been interpreted by the tax courts to mean your cost basis, your adjusted tax cost basis, has to be and always has to be the original cost, as we learned, original cost less depreciation, not just depreciation that you took, but depreciation that was allowable. Meaning, if you didn't take it and you didn't get the deduction, you still have to reduce your basis to the net when you calculate gain or loss on sale or disposition of that asset. What does this all mean? Well, you might want to think about it, but what it means is the following. I buy something for $1,000, it's a depreciable asset, and I forget to take depreciation, and then I go to sell it. So when I go to sell it, I say, well, my basis should be $1,000. I'm selling it for, let's say I'm selling it for $900. I have a loss. That's what you think, because I never depreciated it. I didn't even get the tax benefit. Remember the tax benefit rule? I didn't get the tax benefit here. I didn't take the depreciation, so my gain should be really a loss of $100. But the tax courts have interpreted the word allowable here to mean that if you didn't take the depreciation, too bad. Your tax cost basis would be, your adjusted tax cost basis would be $1,000 you bought, and any depreciation that you didn't take. Let's say it was $250 that you forgot to take. Now you got to reduce this by $750. You didn't take the depreciation, you get the benefit of it, but now when you sell for $900, instead of a loss, you got a gain. And you're going to pay tax on that gain. And that's what the tax courts have interpreted, the word allowable. The good news is that today it's not as important to worry about, because the IRS allows you to take depreciation you missed. You can take the depreciation you missed. So when you go to sell, if you find that you forgot to take the depreciation and your adjusted tax cost basis has to be reduced to the lower amount because of the word allowable, then at least in that year you can take the depreciation you missed. Of course, you got to recognize that you missed it, but even if the IRS comes in audits, they'll let you take the depreciation you missed. So in today's environment, it rarely works out where it becomes a penalty if you forgot to take the depreciation. But the concept of using these two words, allowed and allowable, is now an historic part of our tax system and an historic phraseology of tax practitioners. When it comes to depreciation, they'll always say depreciation as allowed by statute or allowable. And that's what I wanted to point out today. All right, that's it.